holding ESOPs or sold ESOPs, confused about taxation and disclosures, what is the cost, how is it taxed, how to disclose in your return, this video is for you. This video is specifically for employees having Indian company ESOPs. Watch till the end and get clarified. Any specified security or a sweat equity share allotted by your employer or your former employer at free of cost or at concessional rate, then it is a perquisite as per section 17. Specified security includes shares, bonds, debentures, or other securities which can be traded in the market. Sweat equity share is a type of equity share issued by a company to its employees, even directors, either at discount or as a consideration for providing value addition. This perk is taxable at two phases: at the time of allotment of shares and at the time of transfer of shares. At the time of allotment or at the time of exercising the option, the difference between fair market value of the share and the exercise price of the share is taxed. It is taxed in the year of exercising the option. Exercise price is the price paid by the employee to exercise the option. Fair market value we will discuss in few minutes. All these details will be provided to you by your employer through Form 16 or any separate calculation annexure. You should disclose this in perquisite under scheduled salary in your ITR-2 or 3. Next, ESOPs are taxed in the year of exercising the option. But there is an exception. Employees receiving ESOP from eligible startups need not pay tax in the year of exercising the option. Their tax is deferred and paid on a later date. We'll see more about this in next video. So subscribe to my channel. Next phase is at the time of sale of these shares. When you sell these shares, the fair market value is treated as cost, and the difference between the sale price and the fair market value is taxed. If these are listed shares and they are held for more than 1 year, it becomes long term and gets taxed at 12.5 on the gains exceeding 1.25 lakhs. If held for less than 1 year, taxed at 20%. This is disclosed in scheduled capital gain. Let's see the fair market value. If the equity shares are listed in the recognized stock exchange, then the fair market value is the average of opening price and closing price on that date. If it is listed in more than one recognized stock exchange, then the fair market value is the average of opening and closing price, but on the stock exchange which has the highest volume of trading in that share on the date of exercising. In case there is no trading on the date of exercise, then the fair market value is the closing price of the share on the recognized stock exchange that has the highest value of the share, and the date must be close and immediately preceding the exercise date. If these shares are unlisted, then the fair market value is value provided by the merchant banker. Same is the case if securities other than equity shares are issued. Fair market is the value provided by the merchant banker. In this case, holding period and tax rate are different. Holding period is 2 years, so the long term is taxed at flat 12.5% and short term is at slab rate. There is a summary table available. It has all the things which we discussed until now. We still have another topic to discuss. So see you in next video. So don't forget to like, comment, share and subscribe.